Hello everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Today, look, you're looking at the brand there, and anyone in the UK, you'll instantly recognize this. We're going to be looking at P&O Ferries. Now, not to be confused with P&O Cruises, two separate businesses owned by separate parent companies. P&O Cruises is all about cruise lines and taking people on holidays for multiple destinations. P&O Ferries is literally just shipping people from one destination to the other. Now, the reason why this is interesting, for any of those outside of the UK, there's been a recent massive headlines where the company has decided to fire 800 of its staff without much notice. And so there is a lot of discussions with the unions, etc., and even talk about the fact that this action was illegal. So we thought, you know what, let's dig into the finances, just as we did with Thomas Cook, for example, in a past video. We wanted to look at this business and see, do the finances actually tell a story? And could they have warned us of the fact that P&O Ferries were going into trouble? So this one is not a request from one of our viewers. It's one of the 2% of videos that we don't have as a request. However, if you are a viewer watching this video and you do want us to help you analyze the financials of a company, whether you're thinking about investing in them, selling to them, or working for them, do leave a note in the comments section with as much context as possible around why you're interested in this business, and we will look into it for you. So let's jump straight in, right? And I think the finances do tell a story, so stick around in what we found out. Very interesting. We also will have a look at DP World as well, which is their parent company based out in Dubai. So Ted, let's take it away and share with our viewers. I'm sure they're really interested to see what the finances show.
Absolutely. So good to see you, Moeed. Yeah, once again, hello to all our viewers. Don't forget to like, share, subscribe. So please do subscribe if you're not subscribed to the channel. If you like this video, then please do click on the like button and do share it with your friends, with your colleagues. And if you've got any insight, you've got any comments you want to make, please do leave them in the comment section. Please do be polite, though, whoever you're talking about. You know, we can be civil to each other. We don't have to necessarily agree with each other. And you're right, you know, when you say no, you know, very little warning, Moeed, I think it was no warning at all. I mean, literally, they were just told, you know, one day all the boats were kept in the port and they just said, right, that's it, you're out. And unfortunately, my eldest daughter suffered from that because she was meant to be going skiing, and her bus couldn't get on the P&O ferry because the P&O ferry wasn't running. So she had to quickly get the bus, had to get onto a DS, I think. Anyway, so we thought we'd go and have a look at them, and the P&O Ferries, they're not listed companies, so we're not going to be talking about share prices at all in this presentation. But the P&O Ferries, the accounts are available here in the UK on Companies House. Now you have to. There's quite a few P&O Ferries. So it's quite difficult to work out which is the kind of the holding company that consolidates all of the P&O Ferry kind of activities. And I think I've got the right one, which is P&O Ferries Division Holdings Limited. Now I may be wrong. So if anybody has any wise ideas, then please do let me know. Now, these are for the financial year ended 31st December 2020, and the 2021 accounts don't have to be filed until I think it's about October 2022. So these are the latest set of accounts that we can actually access, although of course they are significantly out of date. Now we're going to whiz straight through and get into the kind of the juicy numbers. That's what we're really interested in. And here we go. So now, it's worth bearing in mind this concept of, you'll see this word here. We don't talk about that word very often, but this word here, limited, really important we understand this. This is limited liability. So this is the limited liability of this business, okay? Which means that the liabilities of this business cannot be laid on the shareholder. Okay, now we have this concept, it's a basis of capitalism, and it means that if you buy a share in a business and the business goes bust, all you're going to do is lose your investment. You don't lose any more than that. So the owners of this company are DP World. I think DP stands for Deep Ports. I think I've done some work with them, but so Deep Ports, so DP World, they own this company. And if you're owed money by these guys and they go bust, you can't phone up DP World and say, hold on a sec, you have to pay my bills, for example. Okay, so we have they are a separate legal entity. Now let's look at some of these numbers. What's going on here? Revenue. Look at this. Revenue is down substantially. So the first thing we notice now, this is probably pandemic related. We'd expect that to be pandemic related. To 2020, the whole the whole world just basically shut down. Nobody's allowed to kind of take any, and these guys would have taken some big hits. So basically $1 billion down to 865 million pounds. Obviously, they don't just take tourists, they obviously take a lot of freight traffic, and the freight traffic keeps on rolling, irrespective of coronavirus, etc., etc. And the cost of sales, they brought the cost of sales down a little bit, but really not enough. And so what we end up with is, in effect, this operating loss, a big, substantial operating loss. Really hit the company hard. That's £100 million operating loss. That's basically what you're looking at there. And then because they've got some debt, they've got some finance costs. That's really where it comes down to. So if you think about the previous year was kind of break even ish, 2019. So normal operations, they're kind of just about washing their face, making it's a 2 million loss. So it's not completely, but it's not a disaster, but 100 million loss. That's where the shareholders, they basically say to Hevelthwaite, the guy in charge, they say to the CEO, look, you got to sort this out. We're not going to carry on holding on to a company that's just making those kind of losses, and he's got to do something about it. So I get it, and to a certain extent, he's slightly between a rock and a hard place, because if you start to think about it, if you're in charge of DP World and you own P&O Ferries, you can either turn it into a profit-making business, or we'll get rid of it. And if you get rid of it, you've really got two options: one, sell it; two, close it down. And if you think about selling it, you kind of think, well, is anybody going to buy a company that's making £100 million loss every year? Maybe there are companies out there that think they can turn it around. Maybe there's some PE companies, but the alternative is that they just say, we'll just put it into liquidation. We'll just close the business down. We'll put the boats on eBay, and that's it. And everybody goes home, and then everybody loses their job. So the CEO is sitting there thinking, I'm kind of between a rock and a hard place. I'm not justifying his actions. I'm not saying that they're the right thing to do, but this is you might call this the unacceptable face of capitalism. This is business, and he's making some pretty tough calls, and he's getting quite a lot of stick for it in the media here in the UK as a result. And I'm not saying that he doesn't necessarily deserve it. I'm not going to judge that, but I'm just saying, what would you do in his position? You've been told by the guys upstairs, cut your losses or we'll close the business down. What are you going to do? He's trying to save the company. So big loss there. If we look at the balance sheet is slightly funny. We have to be quite careful about the balance sheet. So lots of assets. So we've got, there's the property, plant and equipment, which will basically be boats. And they've got quite a lot of intangible assets as well. So these companies, they were grown through acquisition. So there'll be lots of goodwill sitting in there. So you're not going to get anything for that on eBay. You can't sell goodwill on eBay. Standard kind of stuff sitting in their current assets. Substantially less cash than before, because obviously they've been making these losses. Head office is saying, we don't really want to be propping you up. And then if we scroll down a little bit further, we'll see the liabilities. Here are the liabilities. Trade and other payables. Trade and other payables is going up. So they're just, they're really trying to hold on to their cash. They're really squeezing their suppliers. And then they've got these loans and other borrowings, okay? And they've got loans and other borrowings, both short-term and long-term, sitting in there. So what you'll also notice here is that the non-current loans from last year suddenly start to appear to becoming current loans in this year. So this is where they're in danger of potentially breaching covenants. And if you breach your covenants, then the lenders just say, right, that's it. We want our money back. And then suddenly the business falls very, very quickly. So I forget, there's a great book, and I forget, I quoted it in Thomas Cook, and I forget the exact book. Somebody will remember it, I'm sure, and put it in the comments. But somebody was asked, how do companies go bust? And he said, very, very, in two ways. First, very slowly, and then very quickly. And what we're seeing here is possibly a company going bust very, very slowly. And the CEO is, taking some very, very drastic measures in order to try and, turn that tide and stem it. Here we've got the share capital. Now, just a note here, because it's a little bit funny the way they've presented it, but you've got to think about all the negative numbers are positive and all the positive numbers are negative, which I know makes kind of almost no sense, but they do have retained earnings. These are retained profits, not losses, and these are investments by the shareholders. So you see substantial amount of investment by the shareholders, little bit of retained earnings, not a huge amount, and it's come down, and of course it's come down from year on year because of that big loss. And then the other reserves, I'm not sure exactly what they are, probably revaluation reserves, and those are negative. Yeah, just be careful about reading that. It took me a little bit of time to get my head around that. So there's the balance sheet. So the balance sheet is it's not hold below the waterline. We're not kind of just going, oh my gosh, that's it. Moeed, in our time, we've seen some basket cases. We've seen companies which have no cash at all. They're burning cash. They're about to go out of business. You're going to go just look. They're only going to survive with the shareholders propping them up. These guys are not there yet. However, it's tough. It's really, really tough for them. Quite surprisingly, they've actually prepared a cash flow statement. Here's their reserves, the retained earnings. I mean, nothing really to kind of note, just to say, explicitly they're not paying any dividends, but I think you probably knew that already, Moeed. So they're not paying any dividends. They do a cash flow statement, which I thought was quite interesting, because they don't have to. You only have to produce cash flow statement at the kind of the highest level of consolidation. But in terms of their cash flow from operating activities, well, it's positive, not as positive as the previous year, but you'll see that there are negative numbers in there. So why are they positive? Look at this number here: increase in trade and other payables. They're basically, increase in trade and other payables. They have, so these are their suppliers. They're not paying their suppliers. So they're really pushing back on their suppliers to keep the cash in, to keep them alive. If they go bust, those suppliers, 49 million pounds worth, won't be paid to suppliers, and there'll be lots of, add-on businesses which will go bust as a result. And I don't want to justify it. I don't want to sort of say, this is why, and it's all okay. But I just want to try and give maybe a little bit of the other side of the argument that, that the CEO, Hebblethwaite, is just, he's saying, look, I'm trying to make the right decision. I'm not sure, he kind of needed a PR company to help him through that one. I get what he's trying to do. I'm not necessarily sure it was kind of, the best handle in the PR, but he's trying to make good by the by his ex-employees, and trying to pay them. My understanding is acquisitions of property, plant and equipment. This is their capex, and then you'll kind of see the repayment. So there's a little bit of repayment going on, trying to pay down that debt. They've just got quite a lot of debt, and they kind of need to get it under control. So there's the company, as I'm aware, that is the company we'll look at. You can see that kind of the net effect is that the cash has come down. It came down last year as well. So these guys, the cash is going down from 100 to 70, 70 to 30. You can just see, well, the next time it goes from 30 down to 0. And suddenly you end up with, there is no cash at all. And don't forget, this is 2020. So we are now in 2022. So 2021 figures don't have to be produced yet. So, we are well behind. We're looking at something which happened a long time ago. And you kind of feel that, push has come to shove, and that, these guys are probably, really kind of starting to find that the waterline is rising above their chin. So, as you mentioned, Moeed, owned by DP World, and you can get hold of DP World's accounts as well. Now, this is not the ultimate holding company, but this is the kind of the highest level that accounts are available, and you can kind of have a look through these accounts and see what they do. And they do a lot, and they're a big owner of ports, based out in Dubai, and these guys, just so we can have a look at their accounts. They're doing all right. They really are doing all right. So let's just look at, here's the profit and loss account. You can see up here that we've got their turnover. They're in US dollars. They're in dollars this time. They're in thousands. So 10,000 million is, this is nearly 11 billion of revenue. Cost of sales is about 7 billion, leaving them with a gross margin of about 35%, looking pretty healthy. They got some SG&A, so those are the costs of running the business, leaves them with about 2 billion. And then finance costs. Okay, so there's going to be a lot of debt sitting on this company. Kind of makes sense because they're a big infrastructure company, so they'll have lots of debt to pay for that infrastructure. Leaves them with a pretty decent 1 billion, and I know that there are people who will look at this and say, well, look, they're making $1 billion. Why can't they bail out the company? And because that's not business, and that's basically the answer, is that, we talk about this thing called destructive capitalism, where companies that cannot survive go bust. So people like P&O, for example, if they can't make it work, they go bust. And what that does is it allows another operator who's got a different business model, a different way of doing, to step in, and they will then stop, because the demand is there. People want to get across the channel. People want to get to different different parts around Europe. They want to take these ferries to get from A to B, as well as things like flying and the Eurotunnel. So, we have to be very careful that we don't kind of just say, oh, they've got lots of money, they should bail them out and look after them. And I get it. It's that there is that balance there. And again, I'm trying to focus on the numbers rather than get drawn into the kind of the emotional arguments around who should be doing what and why. But these guys, they're making $1 billion. Their balance sheet's looking pretty healthy. So property, plant and equipment, 13 billion of dollars, total 35 billion of non-current assets, things they need to run the business. Quite a lot of goodwill sitting there, which means that they've been growing through acquisition. In terms of their current assets, they've got $4 billion of cash, so they're pretty strong in terms of their cash basis. If you look at their liabilities, down here we can see the biggest liabilities by far loans. And we kind of expect that. So there's a little bit of short-term loans, but mainly long-term loans. Again, if you're going to buy all of this infrastructure, you're going to build it, you're going to build deep water ports, which is what these guys are big on, then you're going to need to raise a lot of money to do that. And then they've got some accounts payable as well. That's quite a high figure, that accounts payable, suggesting that they use their muscle power to push back on payment terms, rather, Moeed, than just going, we haven't got any cash, we can't afford it. So you kind of get a sense that you've got P&O Ferries is just saying, we can't pay our suppliers, therefore we're pushing back. And DP Ports is saying, we don't need to pay our suppliers because we're such a big company, we could just use our negotiation power to get very favorable terms. And again, why not? That's absolutely, that's perfectly perfectly valid business approach. Cash flow statements. Well, you'd be not surprised to know these guys are generating lots and lots of cash. So very, very healthy cash generation going on. And if we scroll down a little bit further, we can see the rest of the cash flow. We can see that they are investing. So, investing to keep the business, ticking along. And then we've got a little bit of effective financing. You'll notice up here, for example, there's a little bit kind of refinancing of loans going on here. And they are paying out some dividends as well. which I noticed not a huge amount of dividends. Okay, so a little bit of dividends, but they are paying out dividends as well, and quite a lot of interest on the debt financing. So I guess we're kind of that it's the tale of two worlds that we're looking at here. So we've got DP World is doing very well, but it's a business, and they're putting pressure on the CEO of P&O Ferries and saying, come on, we want to see you turn it around. And the CEO is making what he thinks is the right calls for the business. But what I see here is, if you take 2020 and you take exactly those numbers and transpose them onto 2021, and the company makes another loss like that, we just saw that, the cash going down, they'll be basically at zero cash now. And if they have zero cash, they can't pay their staff, they can't pay their suppliers, and in effect, they are going to go into liquidation. So, that I'm guessing, and I'm sure that they're not right on the precipice, but they can see that day of reckoning coming, and they're having to make some really, really tough and drastic decisions, as early as possible, and they made them because they knew that the unions wouldn't like it. They couldn't afford the protracted, but they got themselves tied up in quite a few knots at the moment, where boats aren't allowed to leave port because they haven't passed the safety inspections, because the crew are not adequately trained on it. And I reckon there's a few people having some sleepless nights as to how they're going to actually salvage this business. It's a right old mess, Moeed, and quite frankly, I'm quite glad I'm not in charge of it.
Yeah, and this was very insightful. And like we said, we're not here to talk about the ethics or the morals around that. There are other people that are doing that and are qualified to do so. We're here to just give that perspective. And Ted and I have been in charge of large divisions of businesses. I'm chief revenue officer for a couple of companies, nowhere near the scale of what Heatherwaite is going through. So we can't really understand. And we get a lot of comments from our viewers, but how many of them have actually been placed in a situation like this where they have responsibility for thousands of people? I would say probably none of them. So it's a good idea to just have that perspective and just dig into understanding, why did he make that decision? Whether it was the right or wrong decision or not, we're just trying to understand from a financial and capitalist point of view, why would he have made that decision? And I think this video kind of explains the finances behind that. But hey, you may have your own thoughts. So we would love to hear from you. For any of those who are actually in the industry or experts in this industry, we'd love to hear your thoughts. Of course, as Ted always says, do please be polite. And if there are any companies that you would like us to analyze for you, whether you're thinking about selling to them, whether you're thinking about investing in them or joining them, do leave a note in the comment section, and like, share, subscribe as always. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next one.
Good to see you, Moeed. Catch you later.